It was once unimaginable for retail investors like you and I to get exposure to private companies like SpaceX or OpenAI. These walled gardens were only accessible to people like accredited investors, private equity firms, and of course big-name VCs. But today that's all changing. In fact, it has already changed. Because on Solana, at this very moment, we can buy tokenized shares of companies before they even IPO. So why are on-chain stocks important? Where can we access them? And most importantly, is this a riskier way of investing? All that and much more today on Solana Floor. So if you get any value out of this, please consider hitting the like button and of course, subscribe to Solana Floor to support our journalism. It's one click and it really helps us out. $126 trillion. That is the size of the global equities market today, but less than 26 billion of it lives on-chain. That's nothing more than a drop in the ocean. But projects like Remora, xStocks, Ondo, and Superstate are all betting big that thanks to Solana, all of that is about to change. In fact, Solana tokenized stocks attracted over $300 million of trading volume in the first month alone. And even more impressive is that that pace of change, it seems, is accelerating now that regulation has finally caught up.
So the amount of movement that I'm seeing right now within the TradFi is unlike anything I have seen in the almost 10 years that I have looked at it, and it's not even close.
And on that movement, we are already seeing backlash from stock exchanges who just yesterday went crying to the SEC to crack down on tokenized stocks, or blockchain-based tokens as they call them. Here's Ondo's Ian Dabode going on to explain the significance of tokenization.
We believe tokenization is helpful for two things. Number one is enabling global access to an asset that people want, but historically have struggled to get access to. The second reason is tokenization enables you to put something on chain. Why do people want their asset on chain? Because they can also use it in DeFi, primarily as collateral. So putting something on chain just enables programmability, 24/7 movement of the thing. It becomes a better version of the asset than it can be in traditional rails.
Now, to be frank, this development of on-chain stocks and even pre-IPO stocks is about much more than getting upside exposure to any particular asset. It actually delivers on crypto's ethos and its original mission of decentralizing finance and democratizing access to the assets that have been walled off for decades. I spoke with Dragonfly Capital's Rob Haddock a while back. Here's what he shared with me.
The way I think about tokenization and the way I think that the smartest people in the space think about tokenization is being able to bring some sort of off-chain asset, whether that be dollars, whether that be money market funds, whether that be a number of other things, making a digital representation of it where the entirety of the contract or the legal side of whatever might exist there is enforced by smart contracts on-chain.
Rob then went on to explain in layman's terms why this trend is gaining steam from both retail and institutional market participants.
The benefits of tokenization allows for programmability, it allows for immutability, it allows for interoperability that simply does not exist in traditional financial systems, traditional financial networks.
So what's the real unlock here? Well, Superstate is one of the pioneers that we mentioned earlier, and here's what the CEO Robert Leshner told me when I sat with him in Austin, Texas.
What makes RWAs interesting is that you can take traditional assets and you can have them do more when you bring them on chain. And the reason they're able to do more is because they can integrate and be composable with DeFi protocols, whether it's trading venues or borrowing facilities or new ways to program assets, everything is possible on chain.
And it's no longer an exaggeration to say everything is possible on chain, because it was previously impossible to take meme coins like Bonk, Whiff, or even Fartcoin and swap them instantly into the world's most popular stocks like Netflix, Amazon, or Nvidia. On Solana, you can now do this from literally anywhere on the planet, sometimes even without KYC. And those pre-IPO stocks or private companies like SpaceX and OpenAI can be traded on brokerages like Robinhood, or better yet, on Jupiter's pre-stocks. Here's Shaw, the founder of Eliza Labs, explaining to Solana Floor the problem that this new innovation solves.
The problem is that we don't own things. The rich, the super wealthy people in our country own things, and people who are the venture capitalists get in there and they get to buy things. They get exposure to OpenAI, but you and I have no way of investing in OpenAI today. We are totally locked out, because unless you make more than $300,000 as a married person and you have like $1 million in assets in the bank, you cannot be an accredited investor. You're not actually allowed to invest your money into high risk investments. So you have the only opportunity you have for like 100x in your life to like literally change your class or see generational wealth is fucking meme coins.
Now, a word of caution before you go rushing into Robinhood.
From Robinhood's latest push into crypto after the trading platform started offering what they're calling tokenized shares of SpaceX, which of course is a private company, to users, though the users, and I should say, are only in Europe. So this is not available to customers of Robinhood here in the United States. In a post on X, though, OpenAI saying the following. It says, these OpenAI tokens are not OpenAI equity. We did not partner with Robinhood. We're not involved in this. We do not endorse this. Told users, please be careful.
The best way to learn about new instruments is obviously to go and interact with them. But before we dive into xStocks, Remora, Ondo, and Superstate, here's a very quick and painless refresher on why this wasn't possible in the past. In 1944, the Bretton Woods Agreement established the US dollar as the backbone of global trade, and it created the settlement rails that we still rely on today. But fast forward 80 years and those rails are cracking under their very own weight. Because until last year, stock trades took T+2 days to settle. Clearinghouses, custodians, and brokerages sit in the middle as intermediaries in TradFi, and they add costs and they add latency. Global inclusion is limited because billions of people around the world still have zero access to US markets. Enter tokenization, a new Bretton Woods system, if you will. Anyone, anywhere with just a Solana wallet can now own a piece of Apple or Tesla. And the list is of course getting longer by the day. Even BlackRock's Larry Fink, CEO of the largest asset manager in the world, famously said this.
We believe the next step going forward will be the tokenization of financial assets.
Meaning Solana's role is to provide the fastest, cheapest, and of course most composable infrastructure to become that next generation global exchange. Now, before we get to stocks, we do need to talk about stablecoins, because tokenized equities don't really work without them. So, for the sake of argument here, let's think of stablecoins as the gateway drug to a fully on-chain global economy. Now, stablecoins have already grown into a $250 billion market. That's $250 billion. And they've already become the backbone of on-chain settlement, which is increasingly the case with PayFi innovators like Huma Finance leading the charge in DeFi and Solana Policy Institute leading the regulatory developments that we're seeing coming out of Washington, D.C. And if you're still wondering why this is happening right now, it's simple. Back in 2023 and 2024 under Gary Gensler, we had a regulatory gridlock which froze stablecoin growth. US policymakers were worried about US dollar dominance declining as a result. This is why we mentioned the Bretton Woods system earlier. But in 2025, new legislation has unlocked those gates. Stablecoins like USDC are now effectively an on-chain dollar. This powers instant settlement for tokenized stocks, bonds, and of course, ETFs.
The Republicans have very, very squarely and in a very unified way decided to go pro-crypto, pro-blockchains, pro-smart contracts, pro-Oracle networks to a massive degree. What does all that add up to? Well, all that adds up to a headwind becoming a tailwind.
USDC, as you already know, is deeply integrated into the Solana ecosystem, and it has, by most measures, become the default base pair, with billions of dollars of USDC minted on Solana already. Alright, so Solana is quickly becoming the home of tokenized equities, but let's break down the builders. First up, we have xStocks and Backed Finance. These guys are first on the list because they launched in June with over 60 tokenized stocks and ETFs on Solana. Now, they saw $20 million of trading in the first 4 days, and over 20,000 wallets now hold tokenized stocks. The top assets, as you'd expect, are S&P 500, Tesla, and Meta. We also have Ondo Finance, who we heard from earlier. And Ondo is an institutional bridge, if you will. They are building an omni-chain network for real-world assets designed specifically for institutional-grade RWAs. Now, they've partnered with the biggest financial institutions in the world, like BlackRock, Franklin Templeton, and Fidelity on tokenized ETFs. And as you might expect, they are rapidly expanding into equities as both institutional and retail demand grows. Superstate is another pioneer, and we heard from CEO Robert Leshner earlier. They are building an on-chain infrastructure for regulated tokenized bond funds. So, slightly more focused on institutional liquidity pools and soon composable with Solana DeFi thanks to their partnership with Sol Strategies.
Really only two places, right, that an issuer would say, I want my stock. It's either Ethereum or Solana. And so, there's a lot of reasons for that. The user bases are large, the wallet share is large, the amount of capital on chain is large, the amount of DeFi applications large, right? These are the two most ripe environments for RWAs.
We also have Remora Markets, a Solana native project doing things the DeFi way. They're building Solana's native stonks exchange with the original offering to include Nvidia, Tesla, Circle, S&P 500, and of course, strategy shares. and the team is contributing to this original vision of making Solana the on-chain NASDAQ. Remora Markets is set to officially launch in the coming weeks, so we'll be keeping an eye on them. A timely reminder to all the degens out there that none of the information in this video, or on Solana Floor generally, is legal advice, financial advice, life advice, or any kind of advice. Tokenized equities aren't risk-free. There are legal risks, custody risks, and of course, the fact that holders get economic exposure, but no voting rights or protections. And the most obvious risk is perhaps liquidity risk, because tokens can depeg from the original prices, which, as it turns out, isn't always a catastrophe. Here's Ondo's Ian DeBoat explaining that nuance.
So when you tokenize stocks, when you want to buy stocks on chain, the most important thing is when you go to your Robinhood account and you see Tesla trading at 420. When you buy it on chain, you want to be able to buy it at 420. But in some of these implementations, instead of being at 420, it may be sometimes it's at 400, which would be great for you, but sometimes it's at 450, which is less great for you. And even if you then want to easily, swap these back into stablecoins, that liquidity may not really be there. And the reason that this is happening is because there's a disconnect between the trading in TradFi on the NASDAQ, the New York Stock Exchange, and the like, where all of the liquidity for these assets is. And so as a result, the price that happens on chain that is available in these DEX pools and the like can drift up. If there's no connection to easily arb it down, that's when you get the depegging. It's kind of the same thing that we saw with stablecoins. You need 24/5 to 24/7, ideally minting and burning, like connectivity between the TradFi rails and the on-chain rails to make sure that these prices stay in equilibrium.
We also have Oracle dependencies. Pricing, as you know, relies on fees. Manipulation remains an unlikely, but nevertheless possible long-tail risk. And finally, if you ask an ETH maxi, they might mention risks like Solana outages. If the network halts, settlement halts. And that could be a major problem if you want to close your position while prices are dumping. Now, luckily for us, Solana outages are a thing of the past, but despite these risks, adoption is accelerating. RWAs on public blockchains are now worth $26 billion today. McKinsey forecasts a $2 trillion tokenized equity value by 2030, while Ripple and BCG project almost $20 trillion by 2033, factoring in stablecoins and the like. McKinsey added that in a bullish scenario, this estimate could be doubled to around $4 trillion, but that they're less optimistic than previously published estimates as we approach the middle of the decade. So, the $120 trillion question. The world's biggest market is moving on chain. For Solana, tokenized equities represent more than DeFi. This is the foundation for an open, programmable, 24/7 global exchange for all existing assets. The question is, how fast can we reach that multi-trillion-dollar prediction for tokenized equities? And perhaps more importantly, what are the roadblocks that we might hit along the way? Let me know in the comments below, and I'll catch you next time for more of the very latest.